Today we're going to talk about issuing bonds and amortizing them using the effective method. Now, I have videos on amortizing bonds using the straight line method for both bonds, bond discounts, and bond premiums. But here we're going to use the effective method, which is the preferred method. Now, this also means that you have to be comfortable using time value tables. I have a video on time value tables, and I would suggest you watch that if you're not comfortable knowing which tables to use. Okay, I'll show you examples of the tables, but it's something you want to be comfortable with. So let's take a look at this example. On January 15th, we issued $20 million of 2-year bonds. I want to keep it simple. With a contract or stated rate of 8%, that's what's on the actual bond indenture. Now, my other video gives you more definitions and a little more background on bonds. May not be a bad idea to watch that. Here I'm strictly going through the example. So I kind of assume you've read the chapter and you have some familiarity with the terminology related to bonds. Okay, so the contract rate is 8%. Interest is paid semi-annually on July 1st and December 31st. And on the day that we issued the bonds, other bonds that were rated similarly by Standard & Poor's or Moody's based on credit risk had a market rate, or what we call a yield, of 10%. So what we have to do is we have to calculate the market value of the bonds on the day of issuance, which is the present value of all of the payments we're going to have to make. So in this example, I'm going to draw a graph, and again, it's a 2-year bond, and there are semi-annual payments. Okay, so this is going to be July 1st, December 31st, July 1st, and December 31st. This is 2015. This is 2016. So at the end of the 2 years, we have to pay back $20 million to the bondholders. And every 6 months, we have to pay semi-annual interest. So let's calculate semi-annual interest. We take the face value of the bonds collectively, and we multiply this times the contract or stated rate. That would give us annual interest of $1.6 million. Now, since we're making semi-annual interest payments, every 6 months, we're going to cut a check for $800,000 and pay that to the bondholders, who are the investors. Okay, so what we need to do is there are going to be 4 payments of $800,000, and at the end, we have to pay back the $20 million. So this first interest payment gets discounted back. This has to get discounted back to the present value, discounted back at present value. I'm going to switch markers, and discounted back. And then, of course, the $20 million has to get discounted back to today. Today is the present. That's why they call it present value. So now, when you have equal payments in equal time intervals, we call that an annuity. Okay? So we're going to have 2 separate calculations. We're going to discount the $20 million back to the present. Okay, and that's a one-time, or what we call a lump sum payment. And then we have these 4 equal payments, which we call an annuity. So we're going to use the present value of one table, which I'll show you momentarily, to discount the $20 million back to the present value. And we're going to use the present value ordinary annuity table to discount back the interest payments. Okay? Ordinary annuity is when the interest payment, or the payment, I should say, is made at the end of a time period. You would use the annuity due table if the payment was made back at the beginning of the period. Leases are typically payments are made at the beginning of the period. They would use an annuity due. Bond interest is typically made at the end of a time period. We use the ordinary annuity table. So this kind of gives you a visual of how we would structure that. So I'm going to erase this so I can use the board for other stuff. Okay, so let's take a look at the calculations. we have the present value of one table, and we're going to use that to multiply times the $20 million face value. And we have the present value ordinary annuity table, which we're going to use that to multiply the interest payments. So if you look at the calculations, now this particular set of tables truncates the decimal after 3 decimal places. When I was doing the calculations, I used a different table, same exact data, but my decimals were 4 decimal points. This is only 3. So notice 20 million times 0.8227. If you were to go to the present value of one table, you go to the 5% column, and you go to the 4th row, and there you see 0.823, which is very close to my 0.8227. And this brings up an important point. When you have semi-annual payments, what you have to do is you have to multiply the number of time periods times 2. So there's 2 years, but there's 2 payments per year, so 2 times 2, n equals 4. Okay, we always say the number of periods is n. N equals 4 periods, right? 2 years, 2 payments per year. And we cut their interest rates in half. Now, right, make sure you make note of this. Whenever you are calculating present value for bonds, you always use the market rate, not the contract rate. We use the contract rate to calculate the interest payment, the $800,000. But when we're discounting back to present value, we have to use the market rate. This is the rate that the investors require of a bond, just given where the interest rates were on the day that we issued the bonds. Okay, so since 2 years and 2 payments per year, n equals 4, and the market rate was 10%, we divide that by 2. That's why we're using 5% on both tables. So for the present value of one table, 5% column, 4th row for 4 periods, we see 0.823. And again, I used 0.8227 since when I was making these calculations, I was using a different table which went out 4 decimal points. And then for the interest payments, we go to the 5% column for an ordinary annuity table on the right, and the 4th row, and we see 3.546, which happened to be what I used the other time. And you see the present value of 20 million discounted back 4 periods at 5% is 16,454,000. And the present value of the 4 interest payments discounted back 4 periods at 5% is 2,836,800. And when we add them together, that gives us 19,290,800. And we call that the proceeds. That's the amount of cash that the company issuing the bonds will receive. Remember, bonds, we're borrowing money. We're trying to raise money to expand our business. So we received 19,290,800. And at the end of 2 years, we're going to have to pay back $20 million. Okay? So here's the journal entry on the date of issuance. Debit cash for 19,290, credit bonds payable at face value. That's the amount we're going to have to pay back. And the difference between the two, in this case, was a bond discount. Whenever the market rate is higher than the contract rate, you have to drop the price of the bonds. Since we're paying less than what the market requires, we have to discount the bonds, put them on sale. Okay? Now, in the event the market rate were less than the contract rate, the opposite would occur. We would issue the bonds at a premium, and we would raise more than the face value. But this example is a discount because the market rate was higher than the contract rate. So there's our first journal entry. Now, the schedule that you're looking at here is what's called a bond amortization schedule, and it's important that you understand how it works. So notice we start with what we call the book value of the bond. And the book value is simply the face value minus the unamortized bond discount. Okay, so if we were to put up T accounts, here's the bond payable. I'm going to abbreviate bond payable. Always record at face value. And then here is, I'm going to move over a little bit, the discount. Now the real name of this account is called the unamortized bond discount. And this is 709,200. So the book value is the face value minus the unamortized discount, which is 19,290 and 800. We're going to amortize this discount using the effective interest method. Okay, so we start with the book value. Now these bonds were issued on January 1st of 2015. 6 months later, we're going to make our first interest payment. And this is when we're going to amortize the discount. Now, I would suggest you have your calculator in front of you, and I want you to run the numbers as I'm going through this. So if you were to multiply 19,290,800 times 5%, remember that's the market rate, divided by 2, we're going to use that 5% the entire time, you're going to get interest expense of $964,540. And there it is in the middle of the schedule. We're going to pay them $800,000, and the difference between the amount of the payment and the interest expense is the amortization of the discount. Okay, so notice when we amortize the discount, it's going to be a credit. $164,540. Okay, now as of that date, our unamortized discount is going to be $544,660. And I'm going to show you the journal entries momentarily. As of July 1st, 2015, my book value is going to be $20 million minus the $544,660. It's now $19,455,340. So let me show you what's happening with this bond. Here's 2 years, 1 year, and here are the 6-month marks. Okay, so now, let's say this is $20 million right here. And on the day that the bonds were issued, we received $19,290,800. And I'm going to do this. That means this is a compressed graph, it's not to scale. So now, at the end of 2 years, we have to pay them back $20 million. They gave us $19,290,000, and as this bond amortizes, okay, what's going to happen is the book value every 6 months is going to increase, okay, by the amount of the amortization of the discount. Okay, so $20 million. The unamortized discount is now $544,660. $20 million minus $544 gives us $19,455,340. Okay? 6 months later, it's now December 31st of 15. I'm going to multiply $19,455,340 times 5%, and that's going to give me interest expense of $972,767. I'm going to pay them the same $800,000, and the difference between the interest expense and the semi-annual payment of $800,000 is $172,767, and that's the amount of amortization I'm going to use for the discount. And at the end of the first year, my unamortized discount is $371,893. The book value, which is the amount that goes on the balance sheet, is going to be $20 million minus $371, and that's going to be $19,628,107. Okay, now we've done the first 2 payments. I'm going to let you do the last 2 payments on your own. Follow the exact same procedure. And what you'll see, I'm just going to give you the numbers. In the 3rd payment, which would be July 1st of 2016, the amortization would be $181,405. And that would leave an unamortized balance of $190,488. And again, I'll show you the journal entries momentarily. And then the last 6 months, because the bond gets paid back December 31st of 16, the amortization is going to be $190,000, and I came up with $476, and that leaves a whole $12, and this is simply a rounding difference. Okay, so we've fully amortized the bond, and now we have to pay back the $20 million. So let me show you the journal entries. Okay, and you might want to either take a picture of that amortization schedule and have it next to you when you're looking at the journal entries. but you should recognize the numbers. There's the interest expense. That's what's going to go on the income statement. We're going to cut a check for $800, and then we're going to amortize the discount for the first 6 months. 6 months later, there is the second journal entry. Okay, and notice how the book value is increasing as the discount gets closer to zero. The book value will equal 20 million. That's the amount we have to pay back. Okay, so I'm going to erase this right here. Okay, and they're the last two payments, and you should see they will coincide with my T account for the discount. Okay, and so spend some time reconstructing these calculations and the journal entries, and with the amortization schedule in front of you, see how all the pieces fit together. Okay, this is not that difficult an area. And again, a premium is when the market rate was less than the contract rate. A premium is going to have a credit balance. When you amortize the premium, we're going to debit it, and that's going to cause interest expense to be less than the cash payment. Okay, so it kind of goes in the opposite direction. Here, let's explain what this discount represents. Okay, I'm going to go back a couple of slides. Okay, the investors gave us $19,290,000, and we have to pay them back $20 million. In addition to the $800,000 we pay every 6 months, we have to give them $20 million, which is $709,200 more than they loaned us. So what we're doing is that $709,000 represents an additional payment. Rather than call it an expense all at the beginning of the bond or the end of the bond's life, we're going to spread it out. We're going to amortize it. And that's going to add to my interest expense, which is why interest expense with a discount is always higher than the interest payments, as you can see in all 4 of these journal entries. With a premium, it would be the opposite. Okay? So that's basically how the bond works. All right? And don't keep going. I'm going to introduce a couple of additional items now until you feel comfortable with this. Okay, the next issue, and this is not a difficult one, is how do we account for bond issue costs? Bond issue costs are the additional costs a company has to incur because the the investment bank, companies like Morgan Stanley, Goldman Sachs, Merrill Lynch, who help connect the company trying to raise the money to the investing public. This is all done through the Wall Street mechanism. All right, they're going to charge a stiff fee, and you have the CPAs who have to make sure all the numbers and the accounting is done correctly. And you have the lawyers, very legal process, because the SEC, the Securities Exchange Commission, has to be satisfied that all the documentation is there, or else the company's going to get in trouble with the SEC, and they do not want that to happen. So it's an expensive process, and they call those bond issue costs. Bond issue costs get amortized over the life of the bond, and you can use the effective method. It's far more common to use the straight line method, and that's what we're going to do here. The amount of the bond issue cost comes out of the proceeds on the day that the bonds are issued and we receive the cash. Okay, so we're going to use the exact same example as before, and I've added at the bottom, issue costs were $200,000. Then notice we took that $200,000 out of the cash proceeds, and issue costs, which right now it's a debit balance, which it's not really an asset, it's a deferred expense. We're going to spread that out using straight line amortization, and every 6 months we will record issue cost expense of $50,000. I don't have the journal entries here, but it's a pretty straightforward concept. And you can just record it as a separate journal entry. Okay? And so you should notice those other numbers. The discount's the same, the face value of the bond's the same, and the cash proceeds are $200,000 less than the previous example. So bond issue costs are pretty straightforward. The next issue is when bonds are issued between interest dates. Now this is a little confusing. So all I've done now is, instead of issuing the bonds on January 1st, I issued the bonds on February 1st, okay? But the interest payments are still July 1st and December 31st, paid semi-annually. Everything else is the same. We even kept the issue costs the same. Now what's going to happen is this, and I'm going to go to the next slide. It's kind of a busy slide. Okay, so we're going to have to kind of look at this together. All right, bonds trade frequently, just like stocks. Okay, it's difficult to keep track of how much interest somebody earned if they owned the bond for 12 days or 6 hours or 3.5 months. They don't bother doing that. What they do is they're going to cut a check for 6 months interest to whoever owns the bonds on the interest payment date. Now that doesn't mean you can buy the bonds on June 30th and then get 6 months interest. That's not how it works. What they're going to do is they're going to collect all of the interest you didn't earn. Okay, they're going to pay you 6 months interest, but they're going to charge you up front all the interest that you didn't earn. Okay, and so what will effectively happen is you will earn, the amount of interest you earned because you held the bond for a certain amount of time, and the interest expense will work its way out as well. Let's take a look at this example to illustrate this. So we issued the bonds on Feb 1st, and we're going to pay 6 months interest, and really only 5 months went by: Feb, March, April, May, June. Okay, so let's take a look at how we calculate this. First, 1 month's interest for the month of January, in which interest was not earned by anybody since the bonds were issued in February, right? So the month of January was dormant. 1 month's interest, which represents January, is 20 million times the contract rate of 8%. Annual interest is $1.6 million. Divide that by 12 months, and monthly interest would be $133,333. Okay, so let's look at the calculations now. The bond proceeds, that's identical. That didn't change. $19,290,800. That should look the same because it is the same. Look at the journal entry on Feb 1st. I have to walk you through this. Okay, so notice the cash proceeds, $19,224,133. I need to explain how we got to that number. Okay, we debit issue costs, right, just like we did before, and we know that the issue costs come out of the proceeds. And since we're going to pay the bondholders 6 months interest, but they only earned 5 months interest, we're going to collect 1 month's interest from them up front, the $133,000. So take the initial proceeds from our first example, $19,290,800. Subtract the issue cost of $200,000 and add the $133,000 of interest that we collected up front, and that will give you $19,224,133. Okay? And then the last entries, the discount, that's the same. The bond payable, face value, that's the same. And notice we credited interest expense for 1 month's interest. And we'll see how that's going to play itself out in a moment. Okay, in fact, I'm going to erase this, and I'll put the interest expense account up on the board. Okay, so I'm going to put the interest expense T account on the board. And 333 is credited on Feb 1st, okay, which is kind of strange, crediting an interest account, but we'll see what happens. Now on July 1st, our first payment is, the interest expense is $964,540. And this, again, this entry is for 6 months interest, but with that 1 month credit there, the interest for the 5-month period is going to be $831,207. Okay, and that'll be the amount, that's 5 months interest right there, because again, the bonds were issued on Feb 1st, and it's now July 1st. All the remaining journal entries are the same. Okay, it's just that first 5-month period is a little bit different because there's 5 months interest, and that's how we account for it. And so in this example, the bondholder bought the bonds on Feb 1st, held it for 5 months, and they paid 1 month's interest up front. They collected 6 months interest. They effectively received 5 months interest, and we're going to record in our general ledger $831,207. If we were to prepare financial statements on July 1st, semi-annual financial statements, this is the amount of interest expense we would report, $831,207. Okay, hopefully that made some sense to you. That's probably the trickiest part of this whole video. Last issue is pretty tolerable. Let's take a look. Early redemption of bonds, when the investors are paid back before the maturity date. Okay, so companies will sometimes have what's called a call feature on their bonds. They want the ability to be able to pay back the bondholders early if they have the money, since they've been more profitable than they anticipated, or if interest rates have dropped and they want to refinance at a lower rate, they will call in the bonds, they will redeem the bonds, which means they're paying them back early. And sometimes when they have a call feature for callable bonds, they will pay an extra little premium, an additional amount, because they recognize that the bondholders now will want to reinvest money, but they're going to get a lower interest rates because the interest rates have dropped across the board. Okay, same data, same scenario. Now, they were issued on January 1st of 15, so July of 16, after the third of 4 payments, the bonds are redeemed for $19,900,000. At that date, the book value, and if you go back to the amortization schedule, or if you have it on the side there, you took a picture of it, the book value on July 1st of 16 was $19,809,512. So we paid them back more than the book value, which means we have a loss on redemption, which is the difference between what we paid them and what the book value was at the date of redemption. So look at the journal entry. We paid back the bonds, so I'm going to debit bonds payable for $20 million. That clears them out. I'm going to credit the discount for the remaining balance, and again, on July 1st of 16, if you look at the amortization schedule, the discount, unamortized discount, is $194.88. I'm cutting a check for $19,900,000, and then the loss on redemption, which will go on the income statement, is for the difference, again, between the book value and the amount we paid when we redeemed the bonds. And there you have it.